Hi, I'm Lauren Hayes, semiconductor and AI hardware senior analyst at Alphatica. Today I'm breaking down the full AI value chain, where we see the highest conviction opportunities, and why we believe this cycle has further to run. We expect AI-related computing to grow well above GDP for several years, not quarters, years. And the data supports maintaining exposure across the full AI value chain, rather than trying to call the top of the cycle. Here's what we're seeing. Every Magnificent Seven company now has meaningful AI revenue exposure, with Apple remaining the notable exception. S&P 500 earnings grew 28.6% year-over-year last quarter, led by technology at 31.9%. The semiconductor index gained 87.8% in Q2, the best quarter since the index was created in 1993. The investment is accelerating, not slowing. Within AI memory, Micron stands out. This is one of our highest conviction ideas. The stock trades at roughly 8 times fiscal year 2027 earnings despite continued upside to estimates. 45 analysts cover Micron with a consensus target of 1576. Standard deviation is compressing post-earnings, meaning the street is converging on higher targets with increasing conviction. The fundamentals are straightforward. Supply-demand remains tight beyond calendar 2027. 16 strategic customer agreements worth $22 billion provide a contracted revenue floor. Gross margins hit 84.9%, up from 39% a year ago. Capex raised to $27 billion because the company cannot build clean rooms fast enough. And it's not just Micron saying this. SK Hynix listed on NASDAQ yesterday in the largest ADR offering in history at $26.5 billion, oversubscribed 7 times. The stock surged 14% on day one. SK Hynix's CEO said 2027 will be the worst supply shortage in memory history. Customer demand will exceed supply capacity beyond 2030. That's not one company's view. That's both major memory producers telling you the same thing. Micron sees tightness beyond 2027. SK Hynix sees it beyond 2030. The two companies that manufacture the majority of the world's memory agree. There is not enough supply for what's coming. We believe investors should focus on the durability of the AI memory cycle rather than trying to time its peak. But AI hardware exposure doesn't end with chips. Power infrastructure is where the trade is broadening. AI's growing electricity requirements are creating a second wave of beneficiaries: utilities, power equipment, and electrical infrastructure companies. Names like GE Vernova, Vistra, Constellation Energy, and Corning are all levered to the same AI build-out that drives chip demand, but through a different part of the value chain. TeraWulf just signed a 20-year, $19 billion lease with Anthropic for 401 megawatts of AI compute capacity. Pembina approved a $3.2 billion, 932-megawatt data center power project. The infrastructure commitments are measured in decades, not quarters. If you're concentrated only in chips, you're missing half the opportunity. The custom silicon trend reinforces the durability of this cycle. Google's TPUs, OpenAI's Jalapeno with Broadcom, Anthropic designing custom chips, Apple extending through 2031 with Broadcom in a deal worth over $30 billion. Every major AI company is building custom silicon. That does not displace merchant GPU demand. It expands the total addressable market. More chips across more architectures for more workloads. Our view is simple. Don't try to time the top of AI. The companies building this infrastructure are signing multi-year contracts, raising Capex, and telling you supply cannot meet demand through 2027 and beyond. Own the value chain: chips, memory, power, custom silicon. The data says the cycle is durable. This is Alphatica. We track the data.